Living off passive income. It's the ultimate dream, isn't it? The idea that you can just make money while you sleep, maybe sipping something on a beach while the cash just rolls in. The internet is obsessed with selling this fantasy. But the reality? Well, it's a whole lot more expensive and, honestly, a lot more fragile than most people will ever admit. So let's dive into the real math and the hidden traps behind this dream. And it all starts with something you probably paid for this month.
Think about one of your monthly subscriptions. Netflix, Spotify, one of those. It costs, maybe $15? It really doesn't feel like a big deal. It's just a small automatic expense. But what if I told you that $15 has a much, much higher price?
And I mean its true price, not what it costs you this month. I'm talking about what it costs your freedom. What's the real price to pay for that one $15 expense forever using only passive income?
$375. Yep, that is how much capital you need to have invested, working for you, just to generate that $15 a month forever. If that number shocks you a little bit, good, because that little piece of math is the key to understanding the real cost of, everything in your life.
So where on earth did we get a number like that? It's not magic, I promise. It's a really simple rule of thumb that basically powers the entire idea of financial independence, and it completely reframes how you look at every dollar you spend.
It's called the 25x multiplier, and it comes from a famous guideline known as the 4% rule. The basic idea there is that you can safely withdraw 4% from your investment portfolio every year without, theoretically, ever running out of money. Well, the inverse of 4% is 25. So, to figure out how much money you need to be free, you just take your annual expenses and multiply them by 25. That number? That's your freedom number.
And this is where the implications get kind of wild. Every single dollar you spend on an annual basis needs $25 of capital working behind the scenes to support it. Just think about that for a second. A $500 a month car payment, that's $6,000 a year, right? Multiply that by 25, you need $150,000 in your portfolio just to support that car payment. Suddenly, that car doesn't cost $500 a month. It costs a huge chunk of your freedom.
All right, so you know your freedom number. Now what? How do you actually generate the income to make it work? Well, generally speaking, there are two main paths, and people in the finance world love to argue about which one is better. On one side, you've got the total return model. This is where you're selling off little bits of your portfolio, like stocks, and betting that the rest of it grows faster than you're spending it. On the other side, you have the cash flow model. Now, this is what most of us picture. Rent checks coming in, stock dividends hitting your account. You live off those payments without ever touching the original pot of money. Now, the truth is, the smartest people usually build a hybrid of both. But that cash flow model, it has a particularly seductive trap.
You see, the cash flow model just feels so much safer, doesn't it? I mean, you own the asset, it pays you money, you never have to sell it. It's solid. But that feeling of safety, that's exactly why so many people get it dangerously wrong.
This quote right here illustrates the core mistake perfectly. You have to burn this into your brain. People see the money coming in, the revenue, and they confuse it with the money they actually get to keep, the income. Let's use a classic rental property example.
Okay, so you buy a duplex. It rents for $2,000 a month, and you're thinking, sweet, $24,000 a year in passive income, here I come. But not so fast. That's just your gross revenue. The real story starts when you have to subtract all the expenses.
Because from that 24 grand, you have to take out all of this stuff. You've got property taxes and insurance, of course. Then there's the leaky faucet here, a busted pipe there, a month of vacancy when a tenant moves out, fees for a property manager if you hire one, and the big one people always forget, capital expenditures. A new roof isn't just a small repair, it's a massive, predictable cost that you absolutely have to save for.
So, after you strip all of that away, your $24,000 in revenue might be a lot closer to $7,200 in actual spendable income. Suddenly, you don't need one rental property to replace your salary. You might need 10 of them. And that leads to the real punchline here. When you're the one dealing with tenants, coordinating repairs, and managing the property, is any of that really passive? The IRS might call it passive income for tax purposes, but I guarantee your calendar will disagree. You haven't bought freedom. You've just traded in a boss you didn't like for 20 tenants who can call you at midnight. Now, whether you choose the cash flow path or the total return path, there is one risk that can destroy even the most perfectly laid plan. It has nothing to do with your spending or your assets. It has everything to do with timing.
It's called sequence of returns risk, and honestly, it's a terrifying concept. It means the order in which you get your investment returns matters just as much as the average return over time. A big market crash in your first few years of retirement can create a hole so deep your portfolio may never recover because you're forced to sell your assets when their value is at its absolute lowest.
Just look at how this plays out. You retire with $1 million. Year 1, the market drops 20%. But you still need to live, so you pull out 40 grand. Now you're down to 760,000. Year 2, another 10% drop. You pull out a bit more to cover inflation. In just 2 years, you have torched almost a third of your money. The math can break, but more often, it's your nerve that breaks first.
So how do you fight this monster? You need a shock absorber. And this is the protocol. Before you retire, you build a cash buffer of 1 to 3 years worth of living expenses. If the market crashes, you don't even look at your stocks. You live off that cash. This single strategy is the insurance policy that prevents you from being forced to sell at the absolute worst possible time.
Okay, so we've covered the math and the big market risks. But the biggest trap of all might be the one that's inside your own head. It's that constant nagging battle between having enough and always wanting just a little bit more.
This is the classic problem of lifestyle creep. If your spending always rises to meet your income, you never actually get free. You're just running on a faster, fancier treadmill. You hit your first big savings goal, say $500,000, and suddenly you decide you really need $1 million. Then you hit $1 million, and now you think you need $2 million for a bigger house or business class flights. You never actually reach freedom because you keep moving the finish line.
The only way to win this game is to focus on the one variable that you have complete control over. And that's the gap between what you earn and what you spend. Your savings rate is everything. Every dollar you don't spend is a double win. It's one more dollar that goes into your portfolio, and it's one less dollar your portfolio has to generate for you forever.
And that brings us to the final and maybe the most overlooked piece of this entire puzzle. It isn't actually about the money. It's about what you're going to do when the alarm clock stops ringing. So many people achieve financial freedom only to realize they have absolutely no idea what to do with it.
This is the ultimate reframe. The goal should never be to retire from a job you hate. It should be to retire to a life you truly love. We're problem-solving creatures. Without interesting problems to solve, we tend to go a little crazy. True freedom isn't about endless leisure. It's the power to choose your work, your projects, your schedule. It is autonomy. So the final takeaway is this. Design the life you want before you design the portfolio to pay for it. Don't just race to some arbitrary number. Try to build a life you don't feel the need to escape from in the first place. So I'll just leave you with this question to think about. If money were no object, and you had complete control over your time, what would you actually do?